All right, so this video lecture is going to be real brief. We're just going to cover, the basics of what a firm is and the different forms that firms take. And so, real simply, a firm is any organization that brings together resources to produce some good or service or some product in the pursuit of profit. And so, again, this can take a lot of different forms. And there's three basic forms that this takes. The simplest and smallest form this can take is what we call a proprietorship or a sole proprietorship. And so you can think of this as, a self-employed person. They gather resources, they produce some good or service, and at the end of the day, they are the firm. It's them. They are the only person that owns any of the product that is produced, and they're the only one that earns the revenue and the profit. So that person owns all of the property of the firm. That single person makes all of the decisions. They receive all the profit. So see, these are some of the benefits, of operating as a proprietorship. It's just you. You're your own boss. Some of the other benefits that are that a sole proprietorship is very easy to form or dissolve because you don't have to, coordinate with other people. You may just have to fill out some basic paperwork to register as a business, and you're good to go. It's a lot easier to make the decisions since you're the only one making all of the decisions. You don't have to, negotiate or compromise with anyone else. And perhaps best of all, for some people, is that as a sole proprietor, the income that you generate, the revenue that you as the firm generate, is only taxed once. It's taxed simply as personal income. Now, those are some of the benefits, but there's always some, downsides. We got to weigh the pros and the cons. So, one of the downsides is that, as the only person operating the firm, being self-employed, you are legally responsible for everything that happens in the course of conducting the business. And so we say that a sole proprietor faces unlimited liability. Now, what that means is, for example, if you have a lawn care business and in the course of mowing someone's lawn, you run over a rock and it hits a window and it breaks the person's window. Obviously, you are the person performing the service, and so you're liable to replace the window. Now, the unlimited part of that liability comes from the fact that if the lawn care business, don't have enough money or assets to pay for the window, so maybe you need to sell your lawnmower to help pay for the damage. Maybe it was a really nice window, and you don't have the money to afford to pay for the window. Well, maybe you need to sell your lawnmower to cover the cost. Well, if that's still not enough to cover the cost of paying for the damage that you caused, then the person, the injured party, can actually sue you and come after your personal assets. So they may win a civil case against you and say that I'm entitled to be compensated, and that may take the form of you having to turn over personal savings or liquidate other assets. So if you cause a significant amount of damage, there's no distinguishing between you as the lawn care operator, the lawn care firm, and you just an individual person. So we say they face unlimited liability. Now, a couple of other downsides to a proprietorship are it's a lot harder to raise funds when it's just you. So if people that are forming a much larger business, they can go out and sell stocks, sell shares in their company, or they may be able to get a business loan. And so it's going to be much more difficult for a single person to accumulate the funds necessary to go out and purchase the capital and the equipment and the tools you need to conduct the business. And then lastly, since the firm is the person, the proprietor, the single owner, they are the firm. Well, if that person passes away, then the firm ceases to exist. And so then it just becomes a matter of taking, the firm's property, for example, the lawnmower and the other lawn care equipment, since that belonged to the proprietor, which is the same as the individual person, then it becomes the inheritors of the estate or the beneficiaries or the executors of the estate to dispose of that property, because at that point, the firm, the proprietorship, no longer exists. So again, that's the simplest form. Just one person, self-employed. They are the sole owner, the sole proprietor of the business. Now, one step up from that, we go from one to two people, basically, or some number greater than two, and this is what we call a partnership. And so, in a partnership, you have two or more individuals that come together, and they share everything. So they may pool their resources. So they may take the land, labor, capital, and money that they individually have, and they may pool that in order to produce some good or service. Now, in terms of the benefits and the downsides, it's relatively easy to form. Not quite as easy as proprietorship because there may be some additional paperwork or business plans to hammer out because now you're talking about two or more people trying to engage in some business activity. Another benefit is that once you have two or more people, you can start to take advantage of division of labor. And so this can cut down on the time and money it takes just to manage the business. So each person maybe specializes in conducting some part of the business, and so they become specialized. And so the partnership as a whole is much more productive, much more efficient at carrying out its business activities. And then, similar to a proprietorship, with a partnership, you're only going to be taxed once. So the partners are the owners of the firm, and so the revenue that is generated by the firm simply becomes the income of the partners, and so it's just taxed as personal income. Now, of course, there are some downsides. So, like a proprietorship, the partnership faces unlimited liability, which means there's no distinguishing between the assets of the firm and the assets of the owners of the firm, the individuals. With respect to decision making, obviously, anytime you have two people trying to make a decision, there may be some disagreement, and so that may slow down some of the decision making. And of course, the more partners there are, the more chance there is for disagreement, and then that just kind of drags out the decision making process. And the final question is, what if one of the partners exit the partnership or passes away? Well, that one person, that one partner, was a partial owner of the firm. So what happens to their share of the firm when they are no longer part of the firm? And so that may, then again, maybe they have a plan worked out, so it just automatically transfers to the other partners, or maybe their ownership in the firm, passes on to their beneficiaries, their inheritors, and so then, that can cause some problems. Sorting out what happens to that person's share. Now, the last form that a firm may take is a corporation. And a corporation is actually a distinct legal entity. So you may have people that come together and they pool their resources to start a firm, but then they fill out paperwork and they file the paperwork and they establish the corporation as a legal entity. And what this is going to do, perhaps the biggest benefit that this is going to have over a proprietorship or partnership, is that corporation then becomes the legal party. And so it shields the individuals, the owners of the corporation, from having their personal assets seized if there is some damage or harm or injury caused. So if the corporation, right, if somebody working for the corporation causes damage, it's only the corporation's assets that are subject to a court decision to compensate the injured party. So that's the biggest benefit. Another benefit is a corporation as its own legal entity is that in a sense it's immortal. So if one shareholder or many shareholders exit the firm or they pass away, the corporation still exists. Again, it's a paper entity. It exists on paper, and so it continues until whoever the current owners, whoever the current shareholders are, decide to terminate, bring that corporation to an end. And then finally, the last benefit that we typically associate with corporations is that it then becomes a lot easier to raise funds. Obviously, a corporation, we typically think of those as being larger, but it's not necessarily a large firm that becomes a corporation. It could be relatively small, but because again that corporation is a distinct legal entity, that means that investors, lenders may be more willing to supply the corporation with the funds to get started, since they know that the corporation is going to have some limited liability. But then again, there are downsides to forming a corporation. Probably the most significant is that corporate income is double taxed, we say. So the corporation itself as a legal entity pays a corporate income tax. And then whenever the corporation pays its employees or its shareholders, then that income gets taxed again, either as capital gains or dividends income, or as the personal income of the employees. And then finally, another downside is that when it comes to running a corporation, the people, the shareholders that actually own the corporation, are not necessarily the ones that are going to be running the corporation, running the firm on a daily basis. And so what we end up seeing is, in a lot of cases, a principal agent problem, where the principals, these are the shareholders, the owners of the firm, hire an agent like a CEO or a president to actually come in and run the business on a daily basis. And as we'll talk about in a later time, that principal agent problem has the potential to create a misalignment of incentives where the agent who's hired to run the show day to day is not necessarily interested in achieving the same things as the shareholders are. And so that can create some tension. So those are the three basic forms that a firm takes: a proprietorship, a partnership, a corporation. Each form has its own, different pros and cons. And then one last thing to consider is, how many of these firms are there out there? Obviously, there's a lot of firms out there, but it might surprise you to know that in terms of just sheer numbers of firms, there's actually many more proprietorships out there than there are partnerships and corporations. And this makes sense once you remember that a proprietorship is basically, kind of a self-employed person. And so there are a lot of people out there that are self-employed. They work for themselves. So there's handymen, there's babysitters, there's lawn care people, there's accountants, lawyers, doctors. Right? It's just them. So there's a whole lot of those people out there, and they make up about 2/3 to 70% of all of the firms that are out there. But in terms of the revenue they generate, if you think of all of the revenue that's generated by all firms, proprietorships actually make up a very small share of those revenues, maybe 4 to 5% in a given year. Corporations, on the other hand, are the ones responsible for making, the lion's share of the revenue. So, anywhere from, 75 to 80% or more of the total firm revenue out there is generated by corporations. Despite the fact that corporations make up a relatively small number of firms. So only about 20% of firms out there exist in the form of corporation. And that concludes this lecture.